Okay, hi. My name is William Glick, and I'm here with Vadim Clinette, Chaz Hines, and Matthew Terenzino, and we are the Ferris Group. So, for our introduction for the Ferris Group, our mission at the Ferris Company is to analyze, strategize, and implement targeted efforts to strengthen product sales and expand our market presence. We understand that sustainable revenue growth depends on more than just selling more. It requires a deep understanding of our market, our customers, and our own performance. We begin with analysis first, examining sales trends, customer feedback, and market data to identify opportunities and challenges. This helps us make informed decisions and avoid guesswork. From there, we move into strategic planning, whether it's adjusting pricing, launching promotions, or refining our product messaging. Each strategy is built to align with our goals and maximize impact. The final step is execution. We focus on clear timelines, team accountability, and tracking progress to make sure plans are not just made, but also carried out effectively. At the same time, we're looking to increase market penetration by reaching new demographics and improving our presence in existing markets. That might involve new marketing channels, enhanced branding, or improved customer outreach. In short, our mission is about building a strong, data driven path to grow, one that improves sales, strengthens our competitive edge, and ensures long term success for Ferris Company. Okay, moving on.
For the executive summary, so in this presentation, we will talk about and go over several key items about the Ferris Group. First, we'll go over some key highlights of years 4 and 5, particularly detailing sales trends and market highlights. We will then talk about some key financial metrics where we highlight cash flows, our liabilities, and our equity, as well as several other factors and key points. Then we will go over our decision making and how this impacted sales, our customer engagement, and market research. We also highlight some strategic decisions that made and how they impacted us short term and long term. And then next, we'll go over some lessons that we learned during the year and how we adapted to them. Lastly, we'll look at some future outlooks. So moving on.
So for highlights of the year 4 and 5, I put all the rounds just to show our growth from round one, where we made 110 million in sales, and all the way to round five, we made 118 million, which is not that much, but it's a consistent growth from basically about 2 million a year. When we go to market insight, we can see it for our segments. We have an annual growth rate, which basically just improvement everywhere. For the summary, we had a consistent sales growth. Our sales increased every round. Despite our modest market share, we didn't have that much big of a market share, about I think 12 or 13%. We kept growing revenue and showing solid product market alignment. Give me a sec. On that. For the smart segment focus, our performance went up 19.8%. On the high-end product, we went on 16.2%. And for financial health, our contribution margin improved slightly, around 32%, and it kept steady on that. And we did not use any no emergency loans or profitability remained stable across all rounds.
Yeah, and to follow up on Vadim's point, we're just gonna get into three segments here in the key financial metrics. Some of this might be a little reiteration from Vadim's earlier point, but the first point I want to touch on is the financial structure and strength of the Ferris Company. When we're looking at this pie chart here, you see that a large percentage of it is our retained earnings section at 35.4%, which essentially means that our growth was self-financed. As he mentioned, we avoided any emergency debt or equity insurance. So throughout this entire simulation, we did a good job, I think, as a group collectively, just maintaining control over our overall capital structure. And unlike some groups, I think that we are positioned very well for the next 4 to 5 years through our cash flow management, which is the second thing I'll get into. You see down there, in terms of our cash flow, we actually experienced a cash reduction. You see there at 47 and a half. But the majority was a strategic reinvestment in products. 14,000 was in investing activities. And then we have 33,000 in operational outflows. So all in all, no external financing, which I just touched on, was used. So it's really preserving our ownership and our overall independence over our product. And we kind of thought the more we self-finance and self-reinvest, that kind of can set us up once our sales can pick up. As you can see, we were at a 7.3% increase. So if we can continue to increase our sales while staying our ownership, independence, strategic outlook, I think we'll be in a really good spot. And then thirdly, my key takeaway, and touching a little bit on our operational efficiency and our top producers, we kept 100% efficiency rate throughout everything. Our top performers being Feet, Fume, and Fist, each showed total margins over 33%, with Feet at 33.2% being our smallest, excuse me. And so we feel like we've done a very good job overall. I think we're financially disciplined. Operationally, I think we were very efficient during the simulation. And I think in the short race of, the very few weeks we had, we might not have came out on top in terms of overall profitability. But I think if we were to increase this simulation, like you suggested, 4 to 5 years down the line, I think we have positioned ourselves for a large scale sales profit. So we'll move on to the next slide.
Okay, and for the ethical decision making, our ethical decision making plays a critical role in not only maintaining our company's integrity, but also in driving real business growth. One key outcome of sound ethical practices is increased sales figures, especially in our secondary product lines. By setting clear goals for sales growth and monitoring our performance through detailed sales metrics and revenue tracking, we can ensure our strategies are actually delivering results. But it's not just about hitting sales targets. It's about how we manage and reinvest that revenue to sustain long-term growth. Ethical use of profits, such as reinvesting in our teams, customer experience, and innovation, reflects our commitment to responsible business practices. Another major benefit of ethical decision-making is improved customer engagement. Trust is a huge factor in whether a customer chooses to return, and we can build that trust by fostering a more personalized and transparent sales approach. When we prioritize listening to our clients, understanding their needs, and ensuring they're comfortable with their investments, we not only retain their business, but also earn their loyalty. Staying flexible and responsive to customer feedback shows that we respect their voice and value the relationship beyond just a transaction. Lastly, ethical practices allow us to pursue enhanced market reach without compromising our brand integrity. By expanding into new demographics or geographic regions, we create opportunities for growth. But how we do it matters. Our marketing strategies must remain authentic and aligned with what we actually deliver. Misleading promotions or over-promising damages trust and reputation. Instead, by being honest and transparent in our messaging, we not only attract new customers, but also retain our existing base who trust in our consistency and values. In conclusion, ethic decision-making is more than just a moral obligation. It's a strategic asset. It strengthens our performance across sales, customer relationships, and market expansion, laying a foundation for sustainable and principled growth.
So that's a good slide. Good slide. I'll carry on now throughout this slideshow. We'll end up moving into some strategic moves that the Ferris Group made during this presentation. And in our opinion, as a group consensus, moves that we think have paid off and maybe will pay off in the long run. So, we'll talk about some key decisions, and we'll break it down into 3 wins. So first, I'll talk a little bit about the market share growth that we experienced. Maybe not as much as some of us were hoping for, but at the end of the day, it is us carving into the market and increasing our share progressively throughout this. And then another one we'll talk about that has already been touched on by multiple guys in this group. It is our overall financial performance and growth throughout the simulation. And then ultimately we'll go into our differentiation, and we'll go from there. So first we'll touch on the market share growth. The couple bullet points there: we increased our share by 3.1%, and our high-end segment share by 2.4% through customer-focused research and development updates and competitive pricing. So one thing we did a lot and we discussed a lot in this presentation was the change in research and development and how many units we want to produce versus the price that we're asking for these units. All throughout the presentation, we seem to kind of fluctuated until we found a sweet spot, which I feel like we ended up finding towards the end. And that's why, you can kind of see that growth there on the chart. We're just, by round 8, we're steadily growing. And really right from the get-go, we never really had a dip in the market share. So, we're not sure how other groups did, but we were overall pretty positive about the fact that we continue to see an increase in the percentage there. So we went from a total of 16.8% to 20.3% by round 8. And when there's about 6 groups and we have a 20% share, I feel like it's good enough to be long-term profitability. And especially with our financial independence and being in no debt, we really would only think to see that market share grow, especially as other companies have to maybe spend a little bit more money to keep up with us in the long run. So that's kind of it for market share. Next, I'll go into some financial performance numbers. So with smart forecasting and overall controlled operation standpoint from us and constant communication, we scaled from 2.5 million in round 3, almost 3 times that by round 8 to a 9.4 million. And that's kind of when, as I was previously stating, that we seemed to find our sweet spot as the simulation got on. And at first it might have been a little rocky, but we started to see an intense growth towards the back end and almost tripling our profit. We also improved our ROS from 4.2% to 11.6%, which it just really indicates what that's saying is a stronger profitability per dollar earned. And as a business looking for long-scale growth, a larger long-scale growth, just to see our profitability per dollar continuously increasing is only good signs. And especially if if the simulation continued and maybe we're looking for more investors, that would be something that we would definitely share with them. If we ever got on like a Shark Tank with the Ferris group, that's something we would share. And so overall, our product level margins also saw a consistent 6.5% improvement on average. Just kind of goes to back up those previous numbers that I stated in the financial performance. All in all, the financial segment was something that we all kind of had a shared opinion in, and we were overall really happy about where we were. So next, I will go into strategic can't speak, guys. Apologies about that. Differentiation, can't speak, sorry. But by round 8, our automation strategy saved us to 2.1 million in labor annually. So we were able to kind of watch our costs there. New product launches and repositioning efforts, as I talked about through our constant communication, led to an 18% increase in customer awareness and a 12% increase in accessibility in the performance segment. All this is really showing is supporting the graph there on the right. These combined moves created a strong upward trend in all directions. Our strategy just didn't really just look good on paper. When you go and put it into a chart, you can see that we're producing competitive results that we think could only help us long-term here in the Ferris Group. So next we'll be moving on, but thank you for listening to the strategic moves.
So for the lesson learned and adaptations, so for the analysis phase, of course, like we said before, our sales grew. Uh, our top products had a strong sales, but the issue we had was inventory. We had to stock out on our top three products. Like mentioned before, our contribution margin stayed around 32%. We focused on the right segments, but we really needed to expand. I put in a SWOT analysis to mention our strength and weaknesses. So we had top selling products in our growth areas. For our strength, I'm sorry. For weaknesses, I'm sorry. Our market share was low, and once, like I said before, our stock out issues that really didn't let us sell more product, especially for our top products. For opportunities, I put expanding production and inventory and target size segment with new product. For threats was faster competitor adaptation. We had one of the lowest market shares, and on the graph it showed that the other teams were having like a way bigger market share than us, and loss of the old loyal buyers due to our stockouts. So the lesson learned for us, avoid product stockouts. What we could have done with that is improve demand forecasting and increase production capacity earlier to full capture and sales potential. Maintain market share growth. What we should have done is push harder into the fast-growing segments like performance and size, and better defend in traditional and low-end shares. Then refreshing aging products. We haven't done really a good job about that. And what we should have done is invest more in the R&D earlier to update positioning and meet evolving customer expectations. Then we would expand segment presence. What we should have done on that was introduce a competitive product earlier and capture more new demands, and monitor consumer buying criteria more closely. And what we should have done on that was regularly track survey scores and adjust product specs more strategically.
So looking at some future outlook, as we said earlier, we had some issues with inventory, but overall our sales looked pretty good. We're on a promising trajectory currently, as evidenced by recent uptick in sales performance across several of our upper end products. This momentum indicates that we're well positioned to capitalize on future opportunities, most particularly with our higher end, well established products. Um, our projected net income and sales is expected to rise steadily over the next 5 periods at our current pace, which reflects both the strength of our brand and increasing demand in the market. As you can see by the graphs, the red line indicates currently where we're our actual. No, our red line indicates our future projection, and the blue line indicates where we actually were. So there is some momentum going forward, and we're hoping that we can get as close to the red line as possible. There are some things that we could do to accelerate this growth even more. So we could focus on expanding geographically. Um, Entering new regional markets will allow the Ferris Group to tap into untapped customer bases previously, and it will also diversify our revenue streams rather than just being dependent on a single market. We wanted to avoid stagnation. Could be a reason, our sales and net income will go down. So, just getting into more markets is probably a good strategy to go forward. It's also critical that we turn our attention to enhancing the performance of our lower products. As as said earlier, I mean, our higher end products sold out much faster, and we just didn't have the inventory. So, our lower end products didn't sell nearly as fast or as much. So, we can with premium offerings historically they drive down revenue. So, broadening this and then putting more resources into increasing our lower product sales is a strategy we can do going forward. Um, with our current inventory levels optimally aligned for growth, we have the capacity to scale up production and marketing efforts for these products without incurring significant overhead increases.
Will.
So to conclude our presentation here, our sales growth was slow but steady throughout the simulation, and we achieved one of the highest annual growth rates among the competitors in this simulation. We had strong cash reserves, supported decisions with debt kept under control. Market share slightly declined over time and was not a key strength. Frequent stockouts caused customer loss and limited potential growth. And overall, we built a solid foundation, but missed opportunities in inventory and market expansion.